And the first half of 2023 should show you why I think market timing is an impossible dream. Let's face it, every investor does some degree of market timing, and very few of us seem to succeed at it consistently. That said though, 2023 has been a particularly surprising year for people who try to time markets because markets seem to deliver new messages this year.
Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence.
We are in the middle of 2023 and most stock market indices are up between 20 to 30%. This bull market has surprised many investors. In this video, let's take a look at the views of Professor Aswath Damodaran as he revisits and assesses the first half of 2023 and what might lay ahead. Market predictions usually fail. He starts by sharing that he refrains from market predictions because he's just not good at it. The first 6 months of 2023 illustrate why market timing is often an impossible dream. Something that every investor aspires to be successful at, but very few succeed on a consistent basis. At the start of the year, the consensus of market experts was that this would be a difficult year for the market. Due to the macro worries about inflation and an impending recession, and adding in the fear of the Fed raising rates to this mix made bullishness a rare commodity on Wall Street. Markets live to surprise, and the first 6 months of 2023 has wrong-footed the experts, again. Start of 2023. As we enjoy the moment, with markets buoyant and economists assuring us that the worst is behind us, both in terms of inflation and the economy. It is worth recalling what the conventional wisdom was, coming into 2023. 2022 was a bruising year for every asset class, with the riskiest segments in each asset class being damaged the most. There were fears that inflation would not just stay high, but go higher, and that the economy would go into a tailspin. While this may seem obvious, the first step in understanding and assessing where we are in markets now is to go back and examine where things stood then. At the start of the year, Professor Damodaran reviewed the U.S. equities market. S&P 500 was down almost 20%. Nasdaq, overweight in technology, was down more than 30%. While stocks had a bad year, the 8th worst in the last century, the bond market had an even worse one. 10-year U.S. Treasury bonds depreciated in price by more than 19% during the year, the worst year for U.S. Treasury returns in a century. Market surprise. First half of 2023. Halfway through 2023, he thinks it is safe to say that markets have surprised investors and economists again, this year. The combination of high inflation and a recession that was on the bingo cards of some economists at the start of 2023 did not manifest, with inflation declining sooner than most expected during the year. It is true that the drop in inflation was anticipated by some economists, but most of them also expected that decline to come from a rapidly slowing economy, a recession. That has not happened either, as employment numbers have stayed strong. Housing prices have, at least up till now, absorbed the blows from higher mortgage rates and the economy has continued to grow. He acknowledges that the game is not done, and the long-promised pain may still arrive in the second half of the year, but for the moment, at least, markets have found some respite. If you are enjoying this video, we really appreciate it if you can please hit that like button so others can find this video as well, and make sure to subscribe to receive next videos. During the course of 2023, the Fed was at the center of most economic storylines, hero to some and villain to many others. Every utterance from Jerome Powell and other Fed officials parsed for signals about future actions. It is worth noting that there is very little of consequence in the economy or the market, in 2023, that you can attribute to Fed activity. If there is a Fed effect on interest rates, it is almost entirely on the very short end of the spectrum, and not on longer-term rates. This does not surprise Professor Damodaran, as he has never bought into the Fed did it. He has written multiple posts about why it is inflation and economic growth that drive interest rates, not central banks. In US dollar terms, global equities have reclaimed $8.6 trillion in market value in the first 6 months. But the severity of last year's decline has still left them $14.4 trillion below their values from the start of 2022. After strengthening in 2022, the US dollar has weakened against most currencies in 2023, albeit only mildly. The divergence between the S&P 500 and the Nasdaq's performance this year provides clues as to which sectors have benefited the most this year, as risk has receded. The biggest winner, and this should come as no surprise, has been technology, with a return of 43% in 2023. There is no doubt that this market has been largely elevated not just by tech companies, but by a subset of large tech companies. 7 companies, Apple, Microsoft, Nvidia, Amazon, Tesla, Meta and Alphabet, have seen their collective market capitalization increase by $4.14 trillion in the first half of 2023, accounting for almost 80% of the overall increase in equity values. The worst performing industry groups are in financial services and energy, with oilfield services companies being the worst impacted. Rest of the year. Professor Damodaran again reiterates that the lesson he has learned not just from the first 6 months of 2023, but from market performance over the last 3 years, has been that macro forecasting is pointless, and that trying to time markets is foolhardy. But since he is asked a lot about these, he shares 4 points. First, on inflation. That last stretch getting inflation down from 3% to below 2% will be trench warfare, and we will be exposed to macro shocks, from energy prices or regional unrest, that can create inflationary shocks. Second, on the economy. Notwithstanding good employment numbers, there are signs that the economy is cooling, and it is again entirely possible that this turns into a slow-motion recession. Third, on interest rates. I do think that hoping and praying that rates will go back to 2% or lower is a pipe dream, as long as inflation stays at 3% or higher. In short, with or without the Fed, long-term Treasury rates have found a steady state at 3.5% to 4%, and companies and investors will have to learn to live with those rates. Fourth, on equities. The one certainty is that there will be uncertainties, and it is unlikely that the market will repeat its success in the second half of 2023. Time for humility. Professor Damodaran ends his review again by sharing timeless wisdom. If the greatest sin in investing is arrogance, markets exist to bring us back to earth and teach us humility. The first half of 2023 was a reminder that no matter who you are as an analyst, and how well thought through your investment thesis is, the market has other plans. As you listen to market gurus spin tales about markets, sometimes based upon historical data and compelling charts, it is worth remembering that forecasting where the entire market is going is, by itself, an act of hubris.
For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive more videos on memos and write-ups from top investors. Thanks for watching.